Special guest on the live stream today. Say hello to the Discord, Bubba. What are we talking about today? We are going to briefly go over the top 3 reasons why yields are where they are since the COVID low, going against the traditional outcome of where quantitative easing usually takes yields, which is downward because there is more demand for bonds because the Fed's expanding its balance sheet, right? Ugh. Okay. So the 10-year, why is it where it is? Where is it heading? And why is it basically going to destroy all of our lives? So genuinely speaking, the move that has happened on the 10-year in the last 5 years is anything but normal. I mean, the last time anything like this and bond demand has been this low was all the way back during the 1929 great financial crisis of the Great Depression. Looking at the 10-year yield chart over the last 100-something years, you can see that there has always been consistent buying demand for bonds just across the board for government treasuries. They will always be backed by the government in a secure manner that is basically guaranteed. And as a pension fund, insurance firm, and asset manager, you have to make sure you are consistently returning a profit on whatever investments you have in your diversified portfolio. Usually during periods of quantitative easing that you guys can see, and we're looking right in here, 2008 May, okay, is when basically the beginning of the end started for the great housing collapse and financial crisis, which brought the banks down to their knees and they had to get bailed out by the Fed. After this, from the period of 2009 all the way to 2014, during this period in time, liquidity was freshly injected into the system via bank reserves and the repurchase markets, which allowed stocks to churn higher for the next period of 10 years or so until Trump and Powell got in. Now, if you look at what the 10-year did during that same period in time, because bond demand was high, you watched bonds rise and you watched yields fall. This is exactly what you should be expecting as the Fed expands its balance sheet with a high demand for United States treasuries of various maturities. However, during the COVID crisis, which they also implemented quantitative easing, this time, first in 2008 was 4 trillion, this time was 4.7 trillion, the exact opposite happened. Yields exploded off the bottom and ran alongside equities, which made new all-time highs through new freshly injected liquidity. Why? Now, understanding this is arguably one of the most important things that you need to understand in the last 5 years. If you get this, a lot of things will make sense across all asset classes: fixed income, crypto, commodities, equities, real estate even, etc. So let's start with reason number 1, okay? Interest rate hikes. Once the S&P reached its new all-time high in January 2022, Powell then started the fastest interest rate hiking campaign in stock market history. From March 2022 all the way until July 2023, Jerome Powell hiked interest rates from 0 to basically 5.5%, 11 times in that period. This was undoubtedly the number 1 reason why interest rates across the board exploded. And you're talking credit card rates, mortgage rates, auto loan rates, regular loans, even new student loans that debuted during the time. Every single rate you could possibly think of rose to a level that was economically unsustainable. And it has caused massive, massive amounts of debt in the middle class as people are fighting debt with credit, which is also debt, and digging themselves in a hole that unfortunately they're not going to be able to get out of anytime soon. Reason number 2, during Trump's first tenure, $6 trillion were issued by the United States Treasury. Okay, this was on top of the quantitative easing that was printed by the Fed. The issuing of debt and the issuing of new dollars, they go hand in hand. If you issue new debt that has to be paid by somebody, in this case, it was the Fed. The Fed bought those new bonds and injected liquidity into the system to keep it from failing during the COVID crisis. But if there's a period where you issue new debt and there's no quantitative easing to back that up, there's no new freshly printed liquidity to buy that new debt, then it has to come out of the system, which means that assets need to be sold, which is bad for equities and other risk assets across the board. Now, from the COVID low all the way to the 2025 top, there has been $14 trillion of new debt issued in the system. Okay, that's $14 trillion of various bonds, of various maturities. This is dilutive to the global and domestic bond supply. Bond prices down because they're diluted, bond yields rise higher. Investors at this time are demanding higher yields for United States treasuries because they know there's dilution, they know there's rampant inflation, they know that the value of the dollar is dropping. And frankly, any amount of elevated interest rate hikes for a long period of time spells disaster or recession for the economy where GDP is hurt because that's constricting equities and their forward earnings and earnings projections. This causes the yield curve to be inverted as firms buy the longer end of the curve, which raises the price of the longer end bonds, 10-year maturity and out, and lowers the 10-year yields. The yield curve is supposed to look like this during normal operations because the lower end of the curve is being bought more due to just general hedging, diversification, etc. When it inverts, that's when you know an impending recession is on the horizon because firms are hedging for that constrictive environment with higher interest rates in order to beat inflation. And finally, reason number 3, and I think this is the one that everybody misses and it kind of blows over their heads. You guys have to remember that during COVID, trade routes were shut down. Imports and exports were hindered. Global trade as a whole and corporate expansion, corporate borrowing was at all-time lows. All of this can spell for a massive decline in demand for commodities, right? Tangible assets that are traded across from one country to the next. On top of that, you have to remember that Powell made interest rates virtually zero. He also got rid of the fractional banking system requirement and restriction that banks have to hold a certain amount of reserves in order to lend a certain amount of money. Because both of those were made redundant, this created a loose environment for lenders and borrowers to basically lend out as much money as humanly possible that was injected into both bank reserves and the repurchase markets. This made equities insanely favorable over fixed income and commodities. Equities exploded off the bottom because of this, 125%, which inversely creates lower demand in our bond market. Now, hedge funds knew this was coming. So when the COVID crash happened, equities dropped 34%, but bond prices exploded because you were hedging for economic disaster and recession. Once those bond prices exploded, hedge funds took out a $1 trillion domestically short on the bond market. You're talking some of the biggest names in the hedge fund world, Stanley Druckenmiller, Bill Ackman, other hedge funds, etc. You got to remember these firms, they work together. They communicate. They short things together when they see weakness. It's like barracudas honing in on a fish that's bleeding in the middle of the ocean. They trade both ways. They take advantage. Whenever something looks weak, that is an absolute arbitrage opportunity to short. And that's exactly what they did. As equities ran higher, fixed income and bonds ran lower, yields on the opposite end ran higher to attract more investors to the fixed income market, okay? So remember them, study them. No, interest rate hikes, the influx of new debt, which dilutes the bond supply, which sends bond prices down and bond yields up, on top of the fact that equities were in higher demand because fixed income commodities were not desirable products during COVID, which hedge funds took advantage of and ended up with a total global short of over $2 trillion on the bond market that still stands to this day. To conclude simply, the more debt that is issued is going to raise bond yields. The more money that is printed is going to raise inflation, which is going to have to be combated by higher interest rates, which is going to raise the interest payment on bonds, which raises bond yields. And if there is no demand for fixed income at the time and bonds are being shorted aggressively by hedge funds, that is also going to lower the prices of bonds and send yields higher as money flows into equities as the number one most important asset for investors to gain maximum return on their investment. All right. Love you guys. Have a great day. Chat with you soon.